Hey everybody, it's Bob Iaccino, and I'm back to talk to you about why I think gold should be a huge part of your long-term investment portfolio. And this time I want to address a question that I've been getting about the Fed's balance sheet. And that question is, if the Fed's balance sheet is shrinking, which it is, how can gold continue to go higher? Isn't that money coming out of circulation? Isn't that the dollar being revalued? And as a standalone statement, that's true. But there's something different that's going on that I'm going to show you here. And I'm going to show you a couple of charts without getting too deep into the weeds. Um, Essentially, the Fed is reducing its balance sheet. What does that mean? Well, they built their balance sheet up by purchasing assets of various duration: 3-month bills, 5-month bills, mortgage backed securities, 2-year notes, 5-year notes, etc. When those things mature, the Federal Reserve collects money. Okay. Now, what they did in the past is not only were they continuing to buy larger quantities of these things, but when something matured, they took that money and they replaced the old one to make sure that they weren't plussing on one side and minusing on the other side in terms of their balance sheet. Well, now what they're doing is when these things mature and they take in that money, they're pushing that money off to the Treasury and they're not reinvesting. They're not replacing those securities. So when the Fed buys securities, it prints money, purchases those securities, and that money then goes into circulation in the economy, which devalues the dollar and boosts the price of gold. So if their balance sheet is reducing, and it is, as you can see on this chart right here, this is the Fed's balance sheet. Here you can see an increase through this decade from the great financial crisis to the pandemic. And then post pandemic, a massive increase. And then it continued to increase to the right here. And now it's coming off. That means it's shrinking. You can see a little bit of a flat area here. That's important to notice. But what's happening in terms of the money supply is that the Treasury is now doing something to fight the Fed. You've all kind of heard this "don't fight the Fed" narrative in the markets for years and years. The Treasury is fighting the Fed. And how are they doing this? Well, as the Treasury issues new bonds and notes, they've been issuing it more on the short end than the long end. In other words, more 3-month bills, more 6-month bills, more 2-year notes than they were longer term stuff, which is what they used to do in the past. Here's a chart that illustrates that. Okay. This is the all time high bills as a percentage of the last 12 months of total Treasury net issuance of assets. Okay. Here's 2021, which was a recent low. This is when we had money market fund reform, not really important. Here's the pandemic recession. When rates were going way lower, they started issuing more things on the long end because the rates were low. So they got more time to pay it. It's a smaller payment. And here's the great financial crisis. They did the same thing. But now they're still up near this all time high of short end. Well, what does that mean? Well, when they issue 3-month bills and 6-month bills, those mature in 3 months or 6 months. So those are essentially cash. They're not assets because they're bought with cash. And then 3 months later, that cash comes right back in and goes right back out. A 3-month bill, just in its most natural state, is cash. It's a way to hide money for 3 months so that you get a rate of return and then decide when that money comes back what to spend it on. Okay, you're basically just parking money for 3 months. So 3-month, 6-month bills, those things essentially in a functioning economy act as cash. So while the Fed is reducing the cash on its balance sheet and thereby reducing it, or I should say the assets on its balance sheet, and thereby reducing the amount of assets it's holding and not replacing them, they're taking cash out of circulation that the Treasury is putting right back into circulation by issuing shorter term bills. Okay, now I understand that that's complex, but what it's doing is it's further devaluing the dollar with a little bit of a lag, a 3-month lag or a 6-month lag, because those bills act as cash. So, what's the takeaway from this? They're still printing money and they're still manipulating the financial system to their own gain and to your gain if you're in gold and if you're in silver. So Think about what I'm saying here. The government continues to give you more and more reasons to buy gold and silver. And that's why you should be involved with people who want to sell you that stuff at a fair price with a small spread and with great customer service. Cheers, guys.